Welcome back to Finweek Money Matters. Between paying back debt, making smart investment decisions and planning for retirement, it's easy for the good old emergency fund to fall by the wayside. In a world of easy access to investment vehicles like ETFs, does it still make sense to have an emergency fund? To discuss this further, we have Cathy Lammas, a business development manager at Glacier by Sanlam, Alexander Babich, director of Alexander Babich and Associates, and we also have Dineo Tsamela, personal finance blogger at deeonmoneyza. Everyone, thank you so much for making the time to join us. Cathy, let me come to you first. One of our previous guests, Niemand, walked off the set and said, I'm really going to watch this segment because I think it's really silly to have an emergency fund when you can have a bond. What's your response to that?
You know, what's more important is not where you have it, but why you have it,
right,
when you have it, and how big it should be.
Yeah, I mean, I think, Cathy, one of the things that I always find interesting, and I look at myself, I'm terribly ill-disciplined when it comes to it. You know, like if I see the Western Provinces playing rugby, I'll quickly go and grab some money, go and put it into for my weekend punt, or we'll go out for a couple of drinks on the weekend. It comes down to discipline and actually knowing yourself from a personal perspective. Do people actually understand themselves, and do they understand their personal finance habits particularly well?
Sure, and the very nature of an emergency fund is that's exactly what it is. It's an emergency. It's an unplanned event that you didn't know was going to happen, and you need to have that little nest egg somewhere to fund it.
Dino, let me come to you on this. I mean, at a time when access to credit is not necessarily an issue with credit cards and the like, do you find that people still consider an emergency fund as something that's important that they should have?
I think the emphasis on emergency funds isn't as as reinforced as it should be. Because of credit cards and the easy availability of debt, it's so much easier for a person to think, I can just use my credit card because the emergency is happening right now. And they always think, I'll just pay it back over, 4 or 6 months or however long. And sometimes you'll find that people will then go all out and exhaust their credit, funds and access. And then next thing you know, they have no more emergency money, and they have no savings. So it's always important to have that money set aside. I
think unlike Mark, where for me, if Western Cape or Western Province, that's what Western Province is playing, that's not an emergency in my world. But if there's a sale happening at a certain shop that I won't mention, and it's heels that I probably would never have afforded at their full price, then it's an emergency that I need to address. Do you find that people are very variable, Alex, about what constitutes an emergency and what constitutes a Western Province versus shoes incident?
Very good point. In fact, we can use the word emergency as a necessity money. And necessity money is the things that you really value. And if you value shoes and rugby, obviously that's a necessity. That is your emergency, as it were. But I think we need to take a definition of what emergency money is. It's really saving money for a rainy day. It's making sure that you've got money when you really need it. And as you correctly said, whether it's a car breaking down, emergency, somebody ill, or maybe for a burial society, we all need to have that necessity emergency money.
But where do you put it? Because one of the things I find very interesting is the psychology of money, is how accessible that is. So if it's in an overdraft, I can go and I can stick my card in the machine and I can go and grab that money. If I put it into an RA, I can't touch it. In theory, I can't touch it. Can I put into a 7 month? Where do I hide? I know myself that I need to hide that money from being accessible to me on my debit card or on my internet banking or whatever. Where's a good way to put it where it's accessible but not too accessible?
Well, maybe the ladies can expand on that a bit further, but I'd like to maybe from your side, from what Glacier does, for example. But the thoughts that I had when you asked me to talk about the topic is basically it could be literally putting money in a cookie jar or under the bed. That would be for somebody emergency money. You could take it further and say a savings account with a bank. You take it one step further and you go into a unit trust. Take it one step further, it's access money and your bond, your access bond. And of course the real emergency money is when war breaks out in your country and you've got these gold coins and you want to, the woman's jewelry becomes emergency money. So it depends on where you're putting it. So maybe
how big should it be, Cathy, as well?
Just getting back to the where, I am from Glacier, so I'm always going to say a wonderful, diversified Glacier portfolio is the way to go. But in all honesty, an emergency fund is not an investment. It's probably the least sexiest part of your greater portfolio. It's not an investment. You need to put it somewhere fairly low risk where you can access it easily and quickly before you have the financial muscle of a nice share portfolio that's got lots of fat built into it, so it doesn't matter if you dip into a bear market, or a home loan that's built up lots of equity and you can dip into that. An emergency fund are almost like the ugly old brookies that you have to put on to hold everything together before you've got the muscle to do it for you. Your emergency fund is that before you have your financial muscle in place.
Dineo, let me bring you back quickly in. How big should those Bridget Jones Brooks be?
Advice that I got was your emergency fund should be about 6 to 8 months of your monthly living expenses. Now, like Cathy said, this isn't an investment. You should always have this money. It's set aside. It's only and only for emergencies. You'll find a lot of people think that just because they've saved up X much, they can take it and start, investing in unit trusts and ETFs and things like that. And whereas you need to be able to put that money in something like a money market account where it's going to do relatively well in terms of interest, but you have immediate access to it. If you're undisciplined, a 32-day notice account or a 7-day notice account is the best option. It's money, it's set aside, it's not going to go anywhere, and when you need it, you just call the bank.
And if you look at financial planner, the role in the financial planner, because I think it's one of the things that does get neglected in terms of sitting down with your financial planner and actually what if scenarios. Exactly. Obviously we get a lot of the thing. Medical aid is a simple example. We make sure we have enough cover. Do we have money for retirement? Yeah, that should be part of a typical financial plan. Emergency cash on hand at the moment. Well, maybe even just cash on hand. What's its role when you talk to your clients?
As I said, when things really go wrong, I agree with what Dineo is saying. You need about 3 to 8 months. Read the books, Rich Man, Poor Man, Susie Orman, they all suggest 3 to 8 months. It's all relative to the person's need. When I'm driving on the street here and the guy's literally got a few coins in his hand, that's his emergency money, that's his necessity for the day. But we have to expand upon this. Not everyone's got the luxury of having a nice, fat, juicy bank account. But we've got to think like squirrels. The squirrel thinks very cleverly. He puts his nuts away in the summer because there's going to be a winter. Most people don't have that mentality. They spend for today, they don't save for tomorrow. And you get all these sort of crazy things that happen in the world. You're sitting in Cyprus and suddenly your bank account's frozen. So, risk is all over the place. So my suggestion to people when I do retirement planning, or when I do investment planning, is you actually have to sit down and have a plan. And the plan must require discipline, perseverance, and time. And most people generally are ill-equipped or don't have the time, they're time poor to put a proper plan in place. So I think the key area is discipline, having a plan.
Okay, now the role of the access bond then, because sure you look at your clients and a lot of their personal wealth or personal balance sheet sits around the value in the property, the equity that supposedly sits in their property.
Absolutely.
And they use the access bond as essentially their reserve money. Do you advocate that approach?
Absolutely. I think the access bond, look, it has its negative consequences. You go and then suddenly the shoe's there, and you know what happens with your clients. They want to get hold of that money. So let us lead a not into temptation. They want to get hold of that money. So sometimes people need forced savings like retirement annuities, etc. Think of it as emergency money for one day when you get old. But yeah, it depends on how liquid that money is, and it's all about managing cash flow over time. Short-term money, medium-term money, long-term money. I think emergency money could be roughly classified as short-term money, necessity money. And yes, as you've alluded to, it doesn't really earn you good returns, unless you're buying maybe gold coins and speculating a little bit at the same time.
But how realistic is this conversation we're having now when many South Africans are up to their eyeballs in debt, that they can begin, thinking about saving? And so let's compare the number of South Africans that really have emergency funds as against, South Africans who are trying to actually crawl out of a hole they've already dug for themselves. Would you be able to give some insights on that, Cathy?
Sure. Well, first of all, if you say to yourself, I can't afford an emergency fund, actually the opposite is true. You can't afford not to have it. Wanga.com did a really, really interesting survey, and they found that 45% of the loans that people made were for unexpected and sudden expenses. So if it's a sudden expense and you take the first loan you get, you're probably not shopping around for the best interest rates, the best terms and conditions, and so the vicious cycle of debt just starts, and you just get deeper and deeper and deeper. The FSB also, round about last year or the year before, commissioned a study, and the findings were horrible. Less than 1/3 of South Africans have even got 3 months' worth of income saved up.
I want to latch onto that, and maybe Dineo, you can give us insights here. Because growing up, I always grew up with my mother in a number of stokvels, and she was always contributing, and most of the time stokvels were for two reasons: either because when somebody passes, there should be money to take care of that, and Christmas, because it has to be a big party around Christmas time. Are we recognizing the informal mechanisms of emergency funds?
I think to a certain extent, yes, but I also think we need to approach it differently. You know, when I think about when I first started working, there was no one to tell me at that time, when I had no debt and I had no obligations, to say, just put 10% of your salary aside. And had I started then, I'd be much further. Instead, I did. You know, I went out and I could suddenly buy clothes, I could get things on credit, and that's the first thing I did. I bought clothes to look nice at work. And, you know, before I knew it, I was in the cycle. And it had to take a lot of discipline to say to myself, I actually need to stop, because I was headed, you know, in the wrong direction, and I could see that I'd end up in a very big mess. So it's very important to sort of get people, in as much as there are those, you know, stokvels, social structures. I don't know anything about stokvels, so for me, a savings account makes sense. And for all other young people who we're no longer in those kind of environments that, you know, give us the platform to have stokvels. So we need to take our own financial responsibility into our own hands and be disciplined.
Yeah, I mean, maybe I'll jump into a bit of an anecdotal example. So last week, it was obviously just before payday, and the Monday, my debit card got swallowed, and my bank card my credit card got sent to the wrong branch. I suddenly found I've got $300 in my wallet. And so I go into the bank and I say, please, can I get a new card? And just fill in this form, and of course it's the end of the month, so it's a disaster. And so my 10-year-old comes to me and he says, well, what's an overdraft? Because we're talking about the discussion about overdraft. And he says, but he doesn't understand this thing, because I give him X amount of pocket money. He doesn't get an overdraft. So why should an adult be entitled to an overdraft? He said, you've got 300 Rand, make it last to the end of make it last until payday, and then you can go and you can get money again.
How many days away were you from payday?
4 days away from payday. There were a lot of 2-minute noodles chucked into there. But the point was, and I think Dineo touched on something, it becomes a habit that you need to be able to, you need these habits instilled. And if my 10-year-old can tell me there's no purpose to an overdraft, then I as a grown adult should also know those things. And I think that this whole thing about personal financial responsibility is so important, and it doesn't get communicated often enough. And I mean, I think if you look at Glacier clients, the clients that have done well for themselves, and I mean your own clients, Alexander, they're clients that have got a good appreciation of what money is. They know that you spend less than you earn. It's a very simple concept, and yet we still don't seem to be able to communicate it. Cathy, I mean, maybe some insight?
Yeah, and whether it's a formal or an informal saving structure, just getting into the habit of saving is critical, and getting into the habit of doing it early, and paying yourself first. Make your savings a debit order or whatever off of your salary. Alex and I were chatting in the green room before about the value of advice and the studies that have been done showing the difference. Those who have a professional guiding them along the way, showing them where to save, how much to save, and so on. We briefly touched on how much is enough. Well, that's where you need a financial advisor, and Glacier only works with registered brokers and advisors. Your broker or advisor would look at your specific circumstances. There's a guy called Dave Ramsey who wrote a book, and it's widely regarded as one of the top 10 financial handbooks. And he said before you even have an emergency fund, you must have $1,000, which loosely converted as 10,000 Rand, then start on your emergency plan. But you need to ask yourself, with your advisor's help, do I have a home? If it's an old home, a lot more can go wrong. Ditto for a car. What sort of employment do I have? Am I in a job where if I become unemployed, I'm lucky enough, I'll be snapped up immediately, or I go for months without employment? Then the harsh reality is you have to have that many months of emergency fund to cover your loss of income.
Final comments from you, Alex?
I think we've missed the real key issue here for South Africans is we need an education system that includes financial planning. Simple as that. Everyone around this room learned English, biology, science. They don't learn about managing finance. We cannot move ahead without that. Yes, you can have a financial planner, ideal in the top end of the market, but unless we take the average man, Joe, from the street and people like the blogging sites and take them to the next level, we're going to have a massive savings crisis in this country.
And those are the final words from Alex, saying that we cannot move forward without financial planning as a core part of the South African curriculum. Thanks again to my guest, Cathy Lammas from Glacier by Sanlam, Alexander Babich of Alexander Babich and Associates, and Dineo Tsamela from deeonmoneyza. Time now for Befriend the Trend. In this week's Befriend the Trend, we look at the switching economy. Now, Mark, from what I understand from that, I'm thinking we're looking at sectors that are hot and sectors that are not. Am I on the money?
Not quite. It's actually an interesting term. I hadn't heard about it until last week. So essentially the switching economy is the ability of the consumers to be able to switch from A to B. And I think South Africans' best example would be banks. You know, it's hard work to actually switch from bank to bank. It's gotten easier over the last couple of years. But essentially, Accenture have done this report, and they reckon the so-called switching economy is worth $5.9 trillion a year.
Would this include like telecommunications?
Cell phone providers, retailers, clothing manufacturers, hotels, etc. An interesting stat that here, 51% of US consumers switched service providers in the past year due to poor customer service.
Right.
And I think it's a very interesting trend, because I think it is very easy now to switch your service providers. I think there's a lot of consumer legislation in place that stops you being tied into particular services, particular service providers. If you don't like it, you can switch. And I think that if South Africans are serious, well, corporates in general are serious about it, they need to understand customer service comes first, good systems, and you've just got to be able to take responsibility and ownership of that customer.
Are we finding that corporates in South Africa are responding favorably, that they're upping their value proposition to the customer to stop them from switching? Look,
I think for a lot of businesses in South Africa, I mean, I saw a fantastic stat the other day. Woolworths, in 2002, the Woolworths share price was worth R3.80. Today it's worth 77 Rand. So over the last 10 years, corporates have done fantastically well. There's the black middle class has come through, boosted their earnings. They've been able to be quite greedy with what they've got, and I think it reflects in corporate profits. Last 5 years, we've probably started to see a bit of the fallout from the global financial crisis, and people fight for their customers. There are no easy customers out there anymore, and your business has to be geared to protect them.
So clearly, corporates should be befriending the trend and making sure they're mitigating that outflow of customers to their competitors.
Correct. It's easy to switch. Look after it.